Hello traders, Mark Chapman here, the creator of the trademark Trap Traders concepts. Welcome to today's Trap Traders Trade of the Day analysis. Today's date is Wednesday the 10th of May 2017, and the trap we're going to take a look at today is one I refer to as a structure failure Fibonacci trap. And this isn't actually a setup, and the reason for that is there's not too much going on today. I've had a look around, but I thought what I'd do is I'd provide you with a bit of training and show you a particular trap and that you can use in your own analysis and in your own trading when you notice these events. And the real key to this trap is that fundamentally you want to be trading in the direction of the trade. The reason why I'm not taking this trade is because fundamentally it doesn't stack up. Australia is not fundamentally stronger than the US economy, so that's the reason why I'm not taking it. If it was the other way around I would, but yeah, one of those things. But one of the main things is that you want to be obviously trading in the direction of the fundamentals. The next thing is that you want to have clear context pre-trap, and that sounds a little bit fuzzy, but basically you want a very obvious price movement preceding the trap itself. Alright, so if you were looking at any of these moves really, at the hard right edge, these are very seducing and inducing types of events. You've got vertical price action, very eye-catching, strong movement, volatile, very clear for the eye to see, big candles. And what that does is, if you think about your own experience with trading and taking a trade, what's the processes by which you go about taking a trade? What do you first of all start to consider? And you know, after years and years of looking at this and thinking about this, it tends to be, in my opinion, the patterns, right? The price action that gets you interested. It's the price action itself that does that. And once you notice certain patterns, it highlights that location on the chart and then gets you to, from there, start to do some analysis. Now you may do some analysis and find that, you know, there's nothing there, but usually it precedes the analysis, and then the analysis, if all things being equal, stacks up. Then at that point you still haven't taken the trade. If you just think through your own experiences, what is it then that makes you pull the trigger? And it's that entry cheese, which I refer to all the time, at the hard right edge, that does that. So you've got a situation where the market makes a new low, then it makes a lower high, right, which is lower than that one, and then a new low, and it pulls back, and here's that entry cheese I was talking to you about, right, into the 50% fib. And if you just took on board the Fibonacci type trader, I'm sure you've probably done something like this yourself historically. Usually we've all given it a go, retracement trading, some type of momentum breakout trading, some type of support resistance level type trading, supply demand, etc. And generally speaking, when you consider a trade like that, you tend to look for historical structures, price coming back into those structures, a price breaking those structures and coming and retracing into them, right? And usually there's probably some level off to the left as well. Getting all together far too many arrows on this on this chart. Let me clear that up. And when price comes back into the location where you believe firmly that price has the potential to react off the level, the final part is the actual reaction itself. Now imagine this was like a big, super big, scary engulfing candle, whatever, maybe it's a doji, something like that. That is the confirming price action that will tend to make you come in off the sidelines and pull the trigger and enter the trade. You know, if you just think about that, what does usually make you pull the trigger? Right? It's all that analysis, everything lining up, and then ultimately you then coming in off the sidelines, because it seems as if it's working. It seems as if, you know, your analysis is correct, and as a result of that, you come off the sidelines and take some risk, right? And now your money's fair game, right? It wasn't a moment ago. If you're just looking at the charts and doing your analysis, etc., and you're not taking any trades, then ultimately that money's never at risk. But as soon as you pull that trigger, then it is. it becomes fair game, right? How do you make money in trading? You take it. Unfortunately, however cold that sounds, that is the reality of the business. Now, that doesn't mean that every trade you take you're going to make money. That's not what an edge is. An edge is something that over time will pay you, but in that instance it doesn't necessarily have to pay you, and that's what a lot of retail traders seem to get wrong. You've got to look at your edge over a consistent amount of prolonged time to see how you're doing. So just because the edge is present doesn't mean you're going to make money. If the edge is present, it means you must act. And in the same case as these people who are taking this trade, you know, they believe this is their edge, so they pull the trigger, come in off the sidelines and take some risk. Now, no sooner does that occur, if we just walk through it, boom, kind of an outside candle, engulfing candle, and it catches them. Now, those types of traders are obviously fairly predictable in where they would place a stop. They would go above the swing, it being the tightest example of that, or above this swing, or, you know, real safety cautious people would go way out. But there's not too many of those. The majority of traders would stick the stops initially in this type of area. But the thing is about that is, when price starts going against them, we know a thing or two about human behavior and under these conditions, and as it goes against them in there, what they'll do is they'll cancel the stop. So if you've ever cancelled a stop, if you just can't face taking the loss, you know this to be correct. It makes you feel uncomfortable. You don't lose the money. Humans hate to lose money even more. You worked hard for that money, so you cancel the stop, and then ultimately that's where all the problems stem from there. Now obviously you're in huge trouble. So imagine you took the trade, your initial stop, and the risk per trade for this particular entry was in here, and you figured out your risk percentage, right? That was acceptable, but all of a sudden now price is up in here, your risk percentage has been distorted, right? You've now broken your rules, you're outside of your processes. If you were taking, you know, say 0.5% risk or percent risk, managing your risk with this stop that you ultimately ended up cancelling, right? You didn't stick to it, you cancelled it. When price is up in here, obviously that's elongated your risk way beyond the risk percentage that you started off when you originally took the trade. Right, so now you're in trouble, and now your risk rewards upside down, and you're in that kind of hope you pray kind of land, and that's really what this trade ultimately does. Again, if your stop was above there, you cancel it. I don't really want to go through that all again, but you get the idea. You would have cancelled it there as well, put you in more trouble if that's where you'd have placed your stop, etc., etc. Now I want you to think about the psychology of these individuals, and they're still stuck in this trade, right? They've been jammed up in that day in history, and they can't get beyond that reality, which is they're in a drawdown, and they're in too much of a drawdown, and they can't get out of it unless it comes back. Now, if they were to be lucky enough for price to come back into that level, you just think about their psychology. What are they going to do? Right? They're going to bail. So as price comes back into this area, there's no book in the world that tells you that that's a level that should be a level of support. But the reason why it acts as support is because those traders are bailing. It's also a demand level, right? It's like hidden demand almost, and that's why you're seeing, it's not a surprise to see a reaction over there. So you would look to take this normally. As I said, this is just a training video. There's not really any trades kicking around today, so I just thought I'd do this for you. And this is a structure failure Fibonacci return trap. And I hope you found that interesting, guys. If you'd like to come and join me in my brand new inner circle to learn all of these tactics, we've deconstructed the trading strategies of many market participants and get a real edge in the financial markets, then click the link below and I'll see you on the inside.